Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Northern Dynasty are plunging today after the U.S. Justice Department said it is upholding a previously imposed veto on mining at the company's Pebble deposit in Alaska. The Vancouver-based miner says it prefers a settlement that withdraws the veto, but will continue to pursue the case. Northern Dynasty says the decision could be used as a precedent to stop future U.S. resource projects. Shares of TFI International are trading lower today. The trucking and logistics company saw a drop in profit and revenue in its most recent quarter, weighed down by reduced volumes and weaker market demand. The profit outlook for its current quarter also missed expectations. One bright spot, TFI raised its dividend and repurchased more than $200 million U.S. worth of shares. The Canadian housing market saw prices and sales continue to drop for the month of January. The benchmark home price fell by almost a full percent and now sits at a little more than $665,000, the lowest level in nearly 5 years. The Canadian Real Estate Association says cold weather could be a driving factor behind the drop rather than a decline in demand. And taking a look at the markets after that little bit of a downturn yesterday for the TSX, it's up, getting into record territory. I have to see what the high is, but it's right around there right now, up 1.69%. And south of the border, AI fears easing, and markets are off to the races down there. S&P 500 trying to recover, get above 7,000 again. It's up 0.95. The Dow up by 6.4, and the Nasdaq is up by 1.4 almost. All right, results from Palo Alto and TFI International are driving their shares down after both companies released mixed earnings. Let's discuss more about these shares with Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel. Steve, thanks very much for joining us.
Great to be here, Roger. Thank
you. All right,
you.
We'll start off with Palo Alto, and the numbers weren't too bad. But again, it's one of those, not enough though, isn't it?
Yeah, numbers weren't too bad, but the focus has been on the guidance. And the issue being is that they're okay, the market's okay with the guidance for the revenue, but they're questioning the guidance on the earnings. And that's really because of they're spending a lot of money on doing acquisitions. With the AI revolution that's happening right now, the one group that needs to get in front of that is the security. So while AI creates more of a threat to security, the response is that we need more AI protection. So they've recently bought 3 different companies to help with that. But that, of course, takes money, and that impacts the earnings.
And we heard from I believe it was the CEO. He was on Bloomberg saying, look, we bought some companies, and the numbers are slightly. They look at things slightly different. Things are looking really good here. Is there a reason to believe him on that?
Yeah, I think so. The stock has come off dramatically. It's back to where it was back in April. But it's just a situation where it's hard to prove the technology. It's hard to prove the investments until they actually come to fruition. So it does take time, and we need to give it more time. It's not a stock that I hold, but it's a stock that I do follow closely because it's an interesting space. It's part of the infrastructure for AI security and for the internet and everything we do. So it's a part of the forefront for that, so we'll see how they respond to it.
And what do you want to see from them then?
I want to see that the integration. When you go off and buy companies, there's different types of business models out there where companies can buy companies as a rollover, but no, this is about pure integration and to make sure that they're ahead of the game. And we've seen some of their competitors, like CrowdStrike, have some issues with their security. They shut down the entire Microsoft infrastructure a couple months ago. So we need to make sure that the companies that they're buying and how they're integrated and what the costs are for that. The other issue I'm looking at is the cost of doing business, and the memory chips are so much more expensive than they were. So that's impacting earnings as well. All
right, let's move on. TFI, Canadian company out of Quebec. again, they've had some challenges. It's been a tough go for that sector, and they're not quite out of the woods yet. But how do you think when you look at their numbers? What do you think?
Yeah, not out of the woods. Great cash flow, disciplined capital allocation, so they get gold stars for that. But the market is what it is, and there's been a bit of a freight recession, so they've had to respond to that. Very difficult for them to do. While they're beating on earnings, they missed on revenue. So, but the main focus once again is this cautious guidance. That's really the impact of the overall market right now is guidance. The earnings reports in the States have been phenomenal. The earnings growth for last quarter, with about 75% of stocks reported, it's about 13.5%. And in December, they expected was to be about 9%. So it's a win-win there. So let's continue to focus, but the guidance is really what's driving the market right now.
And what's going to have to change for that guidance to improve?
For guidance to improve, well, it's going to take a bit of time, and we're in this EI revolution right now. So but the companies, that's one end of the spectrum, but the other end of the spectrum is the real economy, and we need more certainty in the trade structure that's happening right now. We need a deal. TFI is somewhat of a poster child for that for Canada. When a year ago they actually did talk about moving down to the States, and their stock got punished by that. But they have to make sure that we do have more trade certainty, so companies like TFI can actually plan more business and plan more structure for their modeling. And
that's CUSMA and the tariffs weighing on it then.
100%. So that's why it's so important that we get a deal. We saw a deal done in Japan yesterday, and we're still not talking to the Americans. So while we were talking to Mexico yesterday and got an MOU, that's great, but MOUs are not deals. We know that in Alberta. We had an MOU on November 27th. We need to have actual business deals done in this country so companies like TFI and the entire economy can bounce back.
Okay, and moving on now, Nutrien. You got it at a hold. What numbers? What do you like? What concerns do you have?
Yeah, I like it a lot. My only concern is that it's moved a little too quickly in a year. It's up about 35%, and so I think it's fairly valued right now. It did bounce back after 2 years, but it's in the right place. It's streamlining. They're looking at divesting their phosphate business. Still strong retail, great dividend. Great stock, but there are some headwinds coming down the road. I think one would be BHP Billiton, or BHP, is completing their potash mine. They're pretty soon, so they're going to start bringing on some competition there, and they're going to have very strong competitive margins there. So I think that's a headwind. The other headwind that they need to do is Nutrien is spending money on developing a port, and unfortunately, it's not in Canada. It's going to be in Washington State. So a couple of headwinds there, but great stock, and it's not something that I think should be sold right now, but I think something that you got to keep an eye on to make sure that they can remain competitive.
All right, we're going to sneak in one more. DoorDash, I think earnings are coming out this afternoon after the close, if I'm not mistaken.
Yeah, correct. Later on today, it's surprisingly it's a very popular buy. The hedge funds released their buys yesterday, and it was one of the top picks after Amazon and Google. But it's at an inflection point. The comparables, Uber, it's starting to make money. It started to make money last year. Uber started to make money 2 years ago, and now they're making money hands over fist. And I think similar to Uber, DoorDash has an opportunity here. They've made some acquisitions. Deliveroo was a company in Europe that they bought in October, which means that they have more international presence. So I expect greater revenue and continue operating leverage improvements here.
All right, Steve, out of time, but thanks as always for joining us.
Great. Thank you, Roger.
Cheers, Steve. Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel at Wellington Altus. Coming up after the break, we're talking to Vivian Tu, social media's rich BFF, on her latest book, Well Endowed. Vivian Tu, the personality behind social media channel Your Rich BFF, has just released another book called Well Endowed. She's a New York Times bestselling author, has 4 million followers on Instagram, nearly 3 million on TikTok. To discuss her new book and social media channels, we were joined earlier by Vivian, the founder and CEO of Your Rich BFF.
My first book, Rich AF, focused all about the basics, getting your financial house in order, things like budgeting, saving, investing, paying down debt. But Rich AF didn't cover the more nuanced moments around your life that happen. Things like making those biggest purchases, your home, your car, that insurance, how to navigate finances in your relationships, for your children, for your parents, and even how to really set yourself up for a successful retirement and then leave something behind through estate planning. And that is what Well Endowed goes over.
Vivian, a question for you just on the investment side of things. So if you're focused on young investors, I've seen a sort of a mismatch between investors that want to get rich now. They want to buy the meme stock, they want to buy the short stock and, have the short squeeze, versus the sort of the reality, which is get rich slowly is a far better thing to do. Can you sort of talk about how your followers sort of adapt to that and what you're telling them and how to manage that process?
Yeah, I think that mismatch comes from a place of feeling incredibly disenfranchised, if I'm honest. This next generation has never really seen an economy that has served them. Their parents were able to work a steady corporate job, take 2 vacations a year, end up with the 2.5 kids, golden retriever named Rover, and still manage to retire at 60, 65. But a lot of young people are feeling like, if I can't hit it big today, then this likely will never happen for me. I try my best to educate the next generation that, frankly, the stories that they see online of the Dogecoin millionaire or some meme stock making somebody rich, that's, 1 in a billion, and likely isn't going to be you. Something that my mentor taught me on Wall Street was that every trade has a winner or a loser. And if there is someone out there who's made all that money off of these incredibly speculative investments, you've got just as many people, in fact, more people who've probably lost that same amount of money. And so I just think it's a little bit frustrating for me, but I tell them the tried and true method is to buy and hold in a diversified portfolio for the long haul.
And it's really changed for a lot of them. They are investing more, I think, than younger generations before. They're not looking at the house as something to own necessarily. I mean, a lot of people feel that it's out of their reach right now. That may change, but they're really focusing more on the markets. And how do you balance that for them? That they want to get rich quick, but also, is a home part of your plans as well, or do you say no, just stay with the markets?
Yeah. So I do think that there has been a little bit of a myth perpetuated across both social media as well as just the financial space, in that if you don't buy a home, you are a loser. And I just don't think that's true. Right now, we know that it is cheaper to rent than buy across nearly all major metros. So it financially may not necessarily make sense to buy. That said, if buying a home is still part of your, lifelong dream, I'm not going to be the one to sit here and tell you not to do it. Not every decision you make has to be a pure play financial one. Furthermore, I think a lot of young people are becoming more creative. The house buying, home buying thing that our parents did was put money into a primary residence. But knowing that primary residences are the one that you live in, and likely aren't going to appreciate the way that perhaps an investment property could, or provide you the type of cash flow that an investment property could. I'm actually seeing a lot of young people have their first purchase, their first home buy, be an investment property that they then further rent out versus having it be their primary residence.
Vivian, one of the issues that we see in Canada is no one focuses on deaccumulation. So assuming one of your followers has done very, very well, it's time to retire. Do you have any good tips for them in terms of how to sort of take that money out and start coasting with the money they've made?
Yeah, I always say make sure that your income from investments essentially replaces your income from labor. If you are able to have a certain set of money that provides you your quote unquote yearly income at a very dependable, consistent return. So say you get a 4 to 5, maybe 6% return on your investments, and that amount of money, those returns can cover your lifestyle. You can actually consistently take that amount out. Furthermore, I think something that folks who are certainly of higher net worth are really interested in doing is actually borrowing against those investments so that those dollars coming in the door don't necessarily count as income. So I think there's a lot of strategies to it, but what I would say makes the most sense for the average person is to keep it simple and just make sure that their dollars invested can essentially provide them a year's worth of income every single year so that they never eat into the principal.
We just got one last question before we go. Thank you very much for joining us, Vivian. This is probably one of the most educated generations when it comes to finances. Does that make it easier, or does that make it harder and more dangerous in some ways?
You know, I think it can be both, to your exact question. Yes, I think it's incredible that the way the internet has essentially democratized access to this information. But I think the most dangerous thing is someone who knows a little bit, right? Because if you don't know anything and you feel very lost with your finances, you won't make any major moves in the hopes that it'll make you a bunch of money. But once you start to get, know enough to be dangerous, you might start to think that you know more than you actually do, and thus end up making some decisions that aren't necessarily prudent. What I would encourage people to do is not just know a little bit, but make sure to do your research on every single financial decision you're making in your life, because it is important. Unfortunately, the work that I do versus, something of a more traditional lifestyle influencer, the consequences are vast. If somebody tells you, you should buy this $12 lip gloss and it ends up being terrible, you've wasted $12. And, unfortunately, that's $12. But if you are taking information from online about investing or budgeting or paying down debt and you make a wrong move, the consequences could be in the thousands. So one, I take my job very seriously. And I always say, don't trust everything you see on the internet, even if it's from me. Just double check, make sure that you have a couple different reputable sources telling you the same thing.
That was Vivian Tu, founder and CEO of Your Rich BFF. After the break, we'll take a look at some of the TSX leaders and laggards, including RB Global. All right, let's see what is trending today. And first up, RB Global. It is up right now. Take a look, about 4%. Now, you saw that big dip, but it's still up for the year, about 8% there. It is going on Q4 results, 2025 results. Shopify is the next one we want to talk about. It's getting an upgrade, and it is up 10%, almost 10%, 9.5%, but still struggling for the year. It's been a rough little haul for it over the last little while, but getting that upgrade. Baytex Energy as well, it is up. Encompass Capital reports a new position in the company, and it's up about 4.25%. And look, for the year, it's up about 41%. IM Gold, another one positive. A lot of people having a good day right now. There are reports mineral resources reserves for 2025 is what's driving that one there. It's up 3.7%. Now, going the other way, sometimes there's winners, sometimes there's losers. The laggards, IA Financial down on its Q4 results, off by 12.37% right now, still up over the last year, but that's a big hit to take for today. Capstone Copper down on its 2026 forecast, off by 7.7%. TFI International, we were just talking about its earnings earlier this hour. A bit of a miss on the forecast. That's what's has some people worried. You can see it's off by 3.8%. And IGM Financial, also down. Leadership changes there, and it's off by 1.5%, we'll say right now. Gibson Energy, last one we're going to look at for the downside, and its Q4 results, not pleasing everyone. You can see it's off by nearly 2% right now. Market turmoil unleashed by AI advances points up to seemingly contradictory fears about the tech. that it won't fulfill its very expensive promise, and that it will swallow up vulnerable industries. Bloomberg Originals has more.
Wall Street is suddenly waking up to the fact that AI might impact a larger number of industries and faster than they had expected.
What this story is about is how AI disruption fear is leading to sell-offs in parts of the market outside technology. On Wall Street, rising fears about artificial intelligence, and specifically where it will disrupt certain companies, are sending shares of those companies tumbling.
Wall Street has done an about-face. Investors were concerned that AI was costing too much and might lead to a big bubble with untold harms. Now investors are concerned that AI is going to be so disruptive that it renders countless businesses obsolete. There's definitely been a spillover, starting with concerns about legal services, SaaS companies, heading into insurance firms, tax preparation services, financial services, each of these in reaction to incremental AI products. The market sell-off really started in early February when Anthropic introduced a plugin to an existing product, one that they did not even really do a formal announcement for.
So what we saw on February 10th, for example, was shares of wealth management companies sell off after Altruist, which is a little-known AI startup, came out with a new tax strategy tool. Look at the stock slides of companies like Salesforce, Charles Schwab, and Blue Owl. Investors are concerned that AI might be able to replicate their offerings soon. The fear for investors right now is that they're going to get caught up in the next version of this sell-off, and so they're really looking for ways to avoid that.
Let's take a step back. In November of 2022, OpenAI kicked off the AI boom. When ChatGPT launched, people were mainly using it to spit out clever song lyrics and poems and pithy responses to things. But what we've seen in the last year or so is that people have been using these to shop for products online, do more advanced online research, and even build apps from scratch with little expertise. Wall Street now seems to be waking up to the fact that those same tools can be used across different sectors.
These tools are coming out and they're good. And so what we're seeing is investors really worried about the parts of the market that are tied to AI risk and looking instead to go more into the AI winners. This chart depicts two baskets of US listed stocks from UBS research analysts. One is AI winners and one is AI risks. So you can see there's been a massive divergence as investors look to avoid companies associated with these risks and flock towards the AI winners.
That technology has been very disruptive in a certain corner of the world, particularly Silicon Valley. But in recent months, it feels like there's been a mainstreaming of it, where we're seeing broader awareness, right? You can use that same technology in your everyday life or in other sectors, even if you don't really want to code.
We've seen video game stocks get hit after a new Google Gemini launch. We saw insurers get hit after a startup came out with a new product. And even more recently, real estate stocks are selling off as investors think that this could be the next place that's going to get hit.
At the moment, Wall Street seems to be whipsawing between two different, extremely opposing views. There are investors who are concerned that tech companies are spending too much money to build AI services with an uncertain payoff. On the other side, investors are anxious that AI will be so disruptive that it renders numerous businesses obsolete.
I've definitely heard sources say that they just don't understand how both of these things can be true at once. They don't think that these knee-jerk reactions would be happening if we weren't near record highs on the S&P. We don't know what next feature or new product is going to be released that sets off the next sell-off, so really we're just watching to see what happens next.
Unsurprisingly, it's hard to predict where things go from here. What's clear is that the large AI developers and a long list of AI startups plan to bring advances to more and more sectors as they try to make money from this technology. So we should expect that if Wall Street is now worried about how disruptive AI could be, there will be plenty more moments in the months ahead for them to be concerned.
Prime Minister Mark Carney officially launching a multi-billion-dollar Canada First buy and build defense industrial strategy that promises contracts to Canadian firms and 125,000 jobs. CTV's Quebec Bureau Chief Jean-Pierre Beauchemin has more.
Prime Minister Mark Carney says Canada has for too long relied on geography and others to protect the country, that his plan overhauls that strategy in a changing world.
It means building a domestic defense industrial base so we are never hostage to the decisions of others.
Others, including the U.S. Still, Carney insisted his strategy to arm the military and boost Canada's defense industry would be complementary, not in competition with American defense supply chains.
First, we will build in Canada and prioritize Canadian companies.
Canadian companies now provide roughly 1/3 of this country's military needs. Carney wants 70% over the next decade, and he wants to increase defense exports by 50%.
That's real growth.
Many of Canada's defense contractors have long focused on exports. This strategy could change that, but the industry says the procurement system has to be much leaner, faster.
If it doesn't happen, it could undermine the entire strategy that we just heard about today.
The government is setting up a defense investment agency to streamline the system, the centerpiece of its strategy. And CAE, the world's largest simulator provider, says it's ready to answer Canada's call.
We're talking about a sea change in spending and focus. And so as the government works on simplifying how to work with contractors, it only accelerates us.
But the Conservatives say that while moving quickly and eliminating bureaucracy is key to boosting Canada's military independence, the new agency won't deliver.
His new proposal adds 6 new bureaucracies, agencies, councils, units, and other bureaucracies that will actually gum up and slow the system down.
But with this major overhaul of defense spending, many say that there's still some fine-tuning to be done to ensure that this strategy becomes reality. Geneviève Beauchemin, CTV News, Montreal.
And earlier today, we were joined by the new head of YouTube Canada. We'll bring you that conversation after the break. GM Canada is investing an additional $63 million in its Oshawa, Ontario assembly plant. The move is for its next-generation full-size truck production, will upgrade operations and enhance its service parts business. This is GM's total investment in Oshawa is now $1.5 billion. The Oshawa plant builds Chevy Silverado light and heavy-duty full-size pickups. It's GM's only North American facility, producing both models on the same line. Shares of RB Global are moving higher today after the company reported profit and revenue in its latest quarter that topped estimates. RB also saw an increase in inventory sales and service revenue, driven by stronger margins and investment in strategic initiatives. RB Global is a multi-channel marketplace that facilitates the buying and selling of commercial assets and equipment. Shares of Bausch & Lomb are down right now, but barely 1.4% right now. That's after the eye health company reported adjusted profit in its fourth quarter that came in below expectations. Bausch says the loss was primarily driven by an increase in income tax provisions. On the upside, revenue came in higher, driven by strong performances in its vision care and surgical segments. Revenue for this year is also expected to grow by 7%. And a quick peek at the markets. Bounce back for the TSX, putting it in and around record territory. It's up 1.6% right now. South of the border, similar situation. Green Day, S&P 500 up by 0.78, Dow by 0.5, and the Nasdaq up by 1.16. AI tech fears easing again. The TSX Venture 50 is an annual ranking of the top performing companies on the TSX Venture Exchange. To discuss the newest list, we were joined earlier by Rob Peterman, Chief Commercial Officer of the Toronto Stock Exchange and the TSX Venture Exchange.
But we had a tie for the 50th spot, so there are 51 companies this year. Looking back, how did the year unfold for them? Look, it was an amazing year. You know, when you look at this list, you'll see it was very much powered by the mining sector. The 51 companies produced an average investor return of 431%, which is an amazing number, but we think the ultimate story is there's a structural gap in a number of commodities, and that gap, the new mines, are going to be discovered by the junior mining companies, and that is what's really exciting for Canada, really exciting for the TSX Venture Exchange to be leading that charge.
Just going back, any concerns that I think it's like 90, I did a quick math, 95% of these companies are mining companies. Any concern that other sectors are being left behind?
Well, look, when we look at the venture exchange these days, it's very much driven by the innovation sector and the mining sector. This was a great year for the mining sector. I think most of us believe we're entering a new commodity supercycle. So it's not surprising that the mining companies were there. We've seen retail investors coming back to the mining sector, generalist investors coming back, and of course, you've got all these geopolitical things going on and sovereign wealth funds as well. So it's not really surprising that the mining sector dominated this year, but we know markets are cyclical, and I expect the innovation sector will show more prominently in years to come.
And with the sovereign, did you see an increase this year? Is there more interest from overseas?
Yeah, I think, we're seeing the investors come from all around the world. Again, generalist investors coming back to the sector. Interest from retail investors. We're coming into the PDAC investor conference here in Canada. But yeah, global interest and the investments from sovereign wealth funds, international governments in the mining sector, a lot of those are into the junior companies on the TSX Venture Exchange. So it's definitely driving a lot of market attention.
All right, now let's talk about some of the 50, and then we'll talk about the rest as well. What are some of the highlights from some of the 51 that are on the list this year?
Yeah, so the two commodities you'll see the most of on the Venture 50 this year, very much gold and silver are the commodities that really dominated the 50 list. You'll see that what we would call Tier 1 mining jurisdictions, Canada, USA, Mexico, were where a lot of those properties are. But if you look at the top three companies on the list, you'll see Santa Cruz Silver at #1. So obviously silver is the commodity that they're working on. Then you have a rare earth company, and the third company is a potash company. So geographical diversity and commodity diversity.
And are a lot of them North American based? Are people staying away from risk? Oh, and there's lots of risk in here, but are they staying away from geopolitical risk?
Well, the 51 companies on this list, the 48 of them are mining companies. They do very much come from what we'd call the Tier 1 mining jurisdictions, so pretty much equally spaced between Canada, US, and Mexico. And there are some other jurisdictions on the list, but there's definitely a consolidation around the Tier 1 mining jurisdictions, and that's a theme that we see all the time in the mining sector, is that where there's certainty and comfort with the jurisdiction, it generally makes investors more comfortable with the process of exploring and moving towards a mine.
Now, these are the top 50. There's about 1,800, I believe, companies in the Venture Exchange. How did it do overall for the year?
The Venture Exchange ended the year at an all-time record for corporate market capitalization. So that's a number that we look at, very positive to see that. The Venture Composite has had a lot of upward mobility this year, but of course, the best companies from the Venture Exchange graduate to the Toronto Stock Exchange. So it's not always perfect to look at the Venture Composite, but the Venture Composite had very strong returns. And again, we ended the year at record market capitalization for corporates on the TSXV.
Now, as you mentioned, mining dominated this year. Is there a rotation going on, like we were talking about with AI and tech stocks? We're seeing some rotation there. Is there a rotation with where people are looking for the next big thing?
Well, from our perspective, a lot of the focus is around, moving into this new commodity supercycle, the really important role that Canada is going to play in that, because we do know that most of the discoveries, the shortfalls that we see in a lot of commodities, those shortfalls will be filled by the junior mining companies and their discoveries. So this ecosystem we have in Canada, the leading global ecosystem for junior mining companies, it's a really important moment for Canada, and with all of the global attention, we think there's going to be continued momentum around the mining sector in the coming year.
That was Rob Peterman, Chief Commercial Officer of the Toronto Stock Exchange and the TSX Venture Exchange. Coming up, North York General Hospital in Toronto is launching a new first. It's an AI tool to tackle one of Ontario's biggest ER problems, crushing wait times. We'll find out more after the break. North York General Hospital in Toronto is turning to AI to tackle one of the biggest problems ERs across Ontario, probably across the country, face, and that's that crushing wait times as they try and process patients. Smarter Zones is a first-of-its-kind tool that spots bottlenecks and helps move patients faster. For more on this, let's bring in Dr. Kevin Wasco, Chief of Emergency Medicine and Program Medical Director at North York General. Doctor, thanks very much for joining us.
Thanks for having me.
Okay, so how does Smarter Zones work? How does it incorporate combining ER and AI? Maybe there's a new word for you there. Incorporating AI to help move people through Emerge.
We worked incredibly hard to perfect some of our processes around ED flow, including the creation of zones within our department where patients with certain conditions are treated in certain areas. What we really needed was a control measure or a safeguard to ensure that if any one of those zones was overloaded, that a patient wasn't meant to wait in a waiting room too long, and they could be moved in to be seen in a timely manner if their wait was deemed to be unsafe or beyond what we were comfortable with someone being able to wait was. So really what this tool does is flags people for our nursing staff that are working at the front end of our emergency department to identify patients who have a prolonged wait time in our emergency department waiting room and move them into available space by giving that nurse options, because they may not have that line of sight into what's available in their department at that time. And then they can opt, if that patient is appropriate for that particular recommendation, they can move them in to be seen sooner.
And now, is this replacing a triage, or is this going to become part of triage?
So it's a tool that's used by the triage nurse, but it's not something that's used in the traditional triage process. The patient is still triaged, they're seen in the traditional manner. This is a safeguard that's running in the background to ensure that once a patient has waited a certain amount of time out in the waiting room, they are flagged to the attention of that nurse so that action can be taken and that they can be seen sooner by a physician.
Is that happening now, part of it, that some patients who maybe the emergency isn't severe, I mean, all emergencies obviously are worrisome, but not as severe as some of the other ones, and they can get lost a little bit in the crowd? Because, I mean, I was looking at the numbers, 11,000 visits at the hospital in December alone.
Yeah, so we're seeing incredibly high volumes of patients at our emergency department. And the triage really is a very quick assessment of the patient's condition, a snapshot at that point in time. But we all know that patients' conditions can change. And so the sooner we can actually get them in front of a physician to be assessed and make a diagnosis, the better. And while a patient may appear to be well on that initial triage, we really do ultimately want them to be seen. We don't want them waiting a period of time that would even prompt them perhaps to leave the department without being seen, because that could be devastating for the patient and something we would never want to see. And so what this really does is ensures that patients don't wait any longer than they would need to, given the volumes of that day, if there's anywhere that they can be seen in the department.
Now, this is put together by Toronto-based Signal One. What kind of a difference do you hope it will make time-wise? Will it speed things up, or will it just make things more efficient?
It really, more than anything, is about patient safety. It won't necessarily improve our metrics in terms of how fast we see the overall number of patients, because we know we actually, as an emergency department, do that pretty well. But it's about catching those outliers that might fall through the cracks on any given day and are waiting longer than what might be typical, and gets them seen quickly. So what we really would expect to see is less time spent in our waiting room by patients and less of our patients leaving the department without being seen. Those are the two things that we are really targeting, and that if we can reduce, we know we'll be successful.
And will it be diagnosing patients at all?
No. So this is really just a flag to help identify patients for nurses who are busy. These nurses are busy seeing patients one after another, triaging them. They might not realize that capacity has opened up in the department. So it's a reminder to them, hey, this patient has been waiting this long. There's a spot to be seen here. Move them in so that they can be seen. And so it's really that safeguard in the background.
And will it have any of the medical information of the patients, or will it just know that this patient is patient number 321 and they've been here X amount of time?
Exactly. It's not interacting with their health information at all. It's really a prompt for our nurses, a reminder that extracts the information about when that patient arrived and where they're destined to go based on the presenting condition, and gets them seen sooner.
And now it's been, have you launched it already?
Yeah, we launched at the beginning of December. And so we're about 8 weeks into its use.
All right. I mean, obviously early. Have you seen a difference? What kind of an impact is it having?
So we have done a lot of improvements at around that same time. We know that our wait times have recently improved, our length of stay has improved, but more importantly, where we think this tool is making an impact is the time that our patients wait in our waiting room has reduced, and our percent of patients who leave without being seen, so they get triaged, but then they leave the department before they actually see a physician, that number has also reduced.
And putting this together, just one last question. Did you work with Signal One on this, or was it Signal One putting it together, or did you work together and say, here's what we need, and throughout the process you kind of tweaked?
Yeah, we worked together with Signal One. We identified where we had an unmet need, and it really was identifying these patients that maybe potentially could be waiting longer than we were okay with. And they worked with us to create the tool, working with some of our frontline physicians and nurses to identify how this could work in a practical sense for our hospital-specific workflows.
Okay, Doctor, thank you very much for joining us. Good luck with it. Hopefully this does make a difference. We appreciate you taking time to talk to us.
Thank you.
Dr. Kevin Wasco is Chief of Emergency Medicine and Program Medical Director at North York General. Still ahead, we'll take one last look at the markets before we go. Take one last look at the markets, then we're going to go celebrate that Canada win over Czechia in the quarterfinals in overtime. Great game. So they're into the semifinals on Friday. Okay, North American markets overall, everybody having a good day. TSX up 1.6, S&P 500 by 0.66, and the NASDAQ up a little over a point right now. And some of the leaders south of the border, Global Payments is authorizing a $2.5 billion stock buyback. It's in there right now, and it's up 16% right now. And Cadence Design, another one we've been looking at today, and see how they're doing right now. And they are up 9%, not too bad at all. And adjusted EPS 805 to 815. The estimate was 803 for them. And one other, MGM Resorts International. It's also up by about 8%. Some of the losers, Palo Alto, taken a hit today on its earnings report. It's off about 5.77. Crown Castle, we just want to sneak that one in too. And it's down 4.6. The last one, Republic Services, the one we'll take a look at before we run out of time here. And Republic Services also taking a hit today. Now, we're going to get to it. There we go. Down 3.3%. That wraps up this edition of Trading Day. Have yourself a great afternoon.